Hello everybody, welcome to JAIIB CAIIB English Medium channel. I hope that your preparation for Indian economy and Indian financial system exam is going fine because we have the exam on 2nd of November. This Sunday, the examination cycle for JAIIB will begin with the exam of Indian economy, Indian financial system. When we talk about the surprises which are there in the IIBF exams, we have seen in the past in May 2025 that good number of numericals were asked in those particular subjects where we do not expect at all, like in PPP as well as in RBWM. So these two subjects are not numerical heavy. Still, in May 2025, IIBF asked good amount of questions. You can say 15 to 20% of the questions based on the formulas. So today in this particular session, we will be preparing you for the upcoming examination of IE and IFS, whereby even if some questions are there based on the formulas, you should be able to answer them. Fine. That is the agenda of this session. We want to have all the formulas discussed here in this particular session so that you can attempt the numericals confidently. So let's get started. First of all, let's revise all the formulas first, then we will be moving on to the solving various numericals. So the numerical problems start off with the formula in the money supply chapter. So measure of money supply, from there on, you will see the formulas are there in your IE and IFS. So unit number 14th, you will find the first formula of your entire IE and IFS. So it starts with the measure of money supply, M naught, then we have M1, M2, M3, and M4. What is the meaning of M naught, M1, M2, M3, M4? See, the M naught is your reserve money, also known as high powered money. Fine. M1 and M2, these are the narrow money. As we move downwards, M3 is known as the money supply, the actual money supply, and M4 is the broad money. Clubbed together, M3 and M4, they are under the category of broad money itself. So as soon as RBI supplies the money to the banks, it is in the form of M naught, which is the reserve money. And how this reserve money becomes this M3, that is the agenda of your chapter number 14. Fine. So we are concerned with the formulas. We must know the formulas for this particular class. First of all, reserve money or high powered money M naught is equal to currency in circulation plus bankers deposit with the RBI plus other deposits with the RBI. So currency in circulation, here you can see that the pictorial representation of each component has also been given, and this PDF you can find in the virtual library also. So currency in circulation plus the bankers money with the RBI, as you know, reserves have to be maintained with the RBI, like there is CRR, cash reserve ratio, plus other deposits with RBI. What are these other deposits? Simply stated, these are the deposits of quasi government and other financial institutions, including the PDs, primary dealers. Then we have the balances in the accounts of foreign central banks and governments, then accounts of international agencies like your IMF. And when we talk about other deposits, this particular component, this is present in M1 also. But in M1, you have to exclude this last component, that is accounts of international agency. These are not in the M1, that you have to remember. So narrow money starts off with M1, which is the 100% liquid money. You will achieve the particular amount of narrow money. You can calculate narrow money using the formula, that is currency with the public plus demand deposit with the banking system plus other deposits with the RBI. In other deposits, as I told you, everything is included, just the money with the international agencies is excluded. Next, we talk about the demand deposits. Everybody knows it is your CASA, the current account, saving account. Currency with public is having a particular formula, not as such formula, but you can calculate it using this particular representation. Currency with public is what? Currency in circulation, the entire circulation minus the cash held by the banks. Okay, because that's people's money only, and in order to avoid the duplication, we have excluded it. Okay, so M naught is done, M1 is done. Then M2 is what? M2 is just the addition of M1 with saving or the demand deposits of post office. Then we have M3, the actual money supply. Whenever in the question in the numericals, you have the term that the money supply of our country is this, then by default, you must remember we are talking about the broad money, that is M3. So M3 is what? M1 plus the time deposit. In M1, we already have the demand deposit, but in M3, you have to include the time deposit as well. So FD, RD, all these time liabilities of the bank, they are under the broad money, that is M3. M4 is what? It is M3 plus all the deposits, be it the time deposits or for that matter, the saving deposits, the demand deposits. Plus, when we talk about the M3, it is having the tag of money supply. So money supply, you add it with the all deposits of post office, you will get the M4, which is the least liquid of all. And you have to exclude National Saving Certificates, NSC, and Kisan Vikas Patra also, because they have longer maturity time period, which is not at all desirable while calculating the actual money supply. Now, this is a chart for your convenience. I have made this so that you can have a quick look while revising the formulas starting from M1 to M4. Next formula, we have money multiplier. How the money multiplies itself in the classes we have seen elaborately. Even if you have not joined the class, still you can gain some momentum here by enrolling in the Power Pack revision batch. Fine, that is also there ongoing right now. So money multiplier is what? Broad money divided by the reserve money, M3 by M0. Or for that matter, money multiplier is also represented by the reciprocal of the reserve ratio, 1 divided by CRR. See these formulas why we are revising right now, so that even if you do not know them or you have forgotten them, then you can answer the questions which we'll be doing in the session. Then we have velocity of money, simple formula, direct formula, nominal GDP by broad money. Inflation rate, it is the CPI, the index of current year minus the index of previous year divided by the index of previous year multiply by 100. That's how you calculate the inflation rate. GDP price deflator, simply nominal GDP by real GDP multiply by 100. Then we have the method of computation of GDP, the most important one being your expenditure method, where we say that all those entities who are making some expenditure, their expenditure is calculated, and we have the formula as C plus I plus G plus X minus M, where C stands for the consumer's expenditure, I for the business investors, G for government, X for the exporters, M for importers, and X minus M is what? Net export. Then income method, here you add all those factor of productions income and you will get the income method for calculating GDP. Product method is what? GDP at market price minus the depreciation plus net factor income from abroad minus your indirect taxes plus subsidies. Simple. Then GNP GDP, how you can calculate? See, GNP is nothing but addition of GDP and the net factor income from abroad. When we take it on the another side, you can have the GDP's formula in relation with the GNP also. Then NNP is what? GNP minus the depreciation. And similarly, you can have the NDP formula also as NNP minus NFIA from here. These two formulas are correlated, you can say. Then after that, the NDP formula, it is NDP at market price, the most important formula. NDP plus indirect taxes minus the subsidy. So NDP at factor cost, or for that matter, when we have the basic price with us, you have to add the indirect taxes in that and subtract subsidies. You will arrive at the NDP at market price. And NDP is what? Basically, NDP is the net domestic product, which is equal to gross domestic product minus the depreciation. After that, we have a formula for personal income. Personal income is derived from the private income, which is for the corporates. So private income, you exclude the undistributed profits, corporate profit, retained earnings of foreign companies and taxes from it, you will get the personal income. And what is private income? Basically, it is the national income, subtract from the national income your income from property, entrepreneurship, commercial and administrative enterprises, minus the savings of non-departmental enterprise of the government, plus interest on national debt, plus the net current transfers from the government, and plus the current transfer from abroad as well. So overall, when we see that these formulas are important for the exam, but the most important formula in this particular slide is this: personal disposable income, PDI, which is nothing but personal income minus personal taxes minus the direct taxes minus fines or the fees received of the government. Then we have important formula in the form of fiscal deficit. India right now no longer uses the revenue deficit as the calculator for its deficit, but you have to know the formula here: total revenue expenditure minus the total revenue receipts. Fine, total revenue expenditure minus total revenue receipts. That is the formula for revenue expenditure. For fiscal deficit or for revenue deficit, fiscal deficit, the formula is simple: total expenditure minus the total revenue, and you have to exclude the borrowings from the revenue. ERD is what? Effective revenue deficit. Simply minus the grants in aid from the revenue deficit, you will get the ERD. And when you subtract the interest payments from your fiscal deficit, you will get the primary deficit. Most important formula is your primary deficit. From here, last exam cycle, one question was asked. Then we have the components of receipts, what all uh, forms the part of your revenue receipt, how we calculate NTR, that is important. See these components, you can pause the video and see for yourself. But when you talk about the formulas, they are important. So net tax revenue is equal to what? It is the gross tax revenue minus the funds which government sets aside for the natural calamity minus the state's share. That will give you the net tax revenue. Fine, that is the important formula. After that, we have one more formula which is important. That is your total receipt. So total receipt is what? Total revenue receipt plus total capital receipt plus the drawdown of cash balance from the previous financial year, that we have to include in the total receipt. Fine. Next important formula will be your yes, principle of indemnity. In insurance, we can expect one question based on the principle of indemnity, which talks about the claim amount. What will be the claim amount? Such kind of questions have been asked earlier also. So it is simply the sum insured divided by the value of insured asset multiplied by the actual loss. And then we have the paid up policy also. What is the paid up value here? Number of premiums paid divided by the number of premiums payable, overall payable, multiplied by the sum in assured. So sum assured is very, very important when we talk about the paid up value, because that is how we will be calculating the final number in the paid up policy. After that, we have formulas for your mutual fund chapter also. So how to calculate return on mutual fund units? The most important formula is your absolute return method. It is given in the absolute return method. How you calculate it? What is the actual formula? Whenever the current market value is given, like here it is given as 7 lakh, and the original amount invested, it has also been given, what will be the absolute return that will be asked? So it is simply the market value minus the original amount invested divided by the original amount invested. And when we talk about calculating it in percentage, you can multiply it by 100 as well. That will give you the return on that particular mutual fund unit. Fine, and that is by using the absolute return method. This is what is the most important one. Then we have the annualized return method also, although not that important, but you can have a look here as well. Okay, now let's start our questions. Fine, now the actual session will begin, where we will be discussing the numericals. So ABC Limited is a profitable company in India. For the past 3 financial years, their average annual net profit before tax has been 100 crore. The company is deliberating on its corporate social responsibility, that is CSR obligations, as per the Companies Act 2013. They have identified two projects. There are two projects, Project A and Project B. Based on the Companies Act 2013, how much is ABC Limited obligated to spend on the CSR activities, and which project or the projects can they undertake to fulfill their obligation? So we have two projects here. Fine. In the past 3 financial, the average net profit is 100 crore, and we know that 2% of the this particular profit, the average net profit of the past 3 financial, 2% will be your CSR obligation. Fine. So project a rural development project with an estimated expenditure of 1.5 CR. First of all, what will be the 2% of your 100 crore? It will be 2 CR. This is the minimum obligation, right? And they can split. Fine, ABC Limited can split this particular obligation in n number of projects. So one obligation states 1.5 CR. Second project, a skill development program for urban youth with the estimated expenditure of 2 crore. Fine. So which projects can they undertake? That is the question. Whether the project cost should be 1 crore, they can undertake project A only, project B only, 2 crore, both the projects, 3.5 crore, some other obligation is there. What will be the right answer here? The correct answer for this question will be option C. 2 crore is the minimum, you can say, obligation, and they can undertake both. There is no stipulation whatsoever when it comes to the type of project. It should be towards the betterment of society, and both the rural development project as well as skill development program will be beneficial for the social cause. Then we have a company failed to spend the mandated amount on CSR activities. Fine. What is the mandated amount? 2% of the average net profit in the past three financials. The amount required to be spent was 6 crore. According to the amended provision, what is the penalty the company would face? What is the penalty? One is the obligation, then we have penalty. So penalties, they are defined how? In two parts. One, the penalty on the corporate, and the another on the officials. What is the obligation, or for that matter penalty on the corporates? It will be what? Quickly try to tell me. And when you talk about the penalty in this particular case, it will be option C only, that is 1 CR, because minimum will be taken. Fine. 1 CR, or for that matter 2x of the obligation, whichever is minimum in case of corporates penalty. Fine. So 1 crore, 2 x of 6 crore will be what? It will be 12 CR, but minimum of these two numbers will be 1 CR. So C will be the right answer. Okay, let's have elaborate discussion on the CSR activities. When you talk about the CSR activities, corporate social activities, they are defined, well defined in Companies Act under Section 135, Schedule 7. How a particular company will evaluate that whether they are being obligated by this CSR activity or not. So out of these three parameters, if they satisfy any, then they are obligated towards CSR activities. If the net worth of that company is more than 500 CR, turnover of more than 1000 CR, and net profit is more than 5 CR. If they are having any of these conditions fulfilled for the previous financial, then they are obligated to shell out some funds for CSR activities. What is the mandatory amount? It is 2% of their net profits in the last three financials. If they are unable to meet the expectation, meet the CSR obligation, then penalty will be levied. What is the penalty? It is 1 crore or twice the amount of your obligation by the defaulting company, that is the corporate. And when we talk about for the officers, the defaulting officers, it will be rupees 2 lakh or 1/10 of the each of your CSR obligation. And out of these two, and out of 2 lakh or 1/10 of the obligation, whichever is less will be charged as a penalty to that particular corporate. Okay. Earlier it was a criminal offense. You have to, serve some imprisonment time also. But now it is reduced to just a civil wrong. You have to only make good of the penalty. Then we have next question. Mr. Sharma invested 1 lakh in a short-term bond fund. After 9 months, the market value of his investment grew to 1 lakh 8,000. Using the absolute return method, what is the absolute return on Mr. Sharma's investment? So simple question, a very simple question. Just now we have seen the formula that the present market rate minus what? Minus the actual amount invested divided by the actual amount invested, that which is again 1 lakh, multiply by 100. That will give you the amount in your final absolute, the final, you can say, growth of your investment via the absolute return method, which will be what? Option A, that is 8%. Okay, so current market value minus the original investment, divide by original investment, multiply by 100%. That will give you the answer as 8% for this particular absolute return. Next, Miss Priya owns a boutique that she established 2 years ago. with an initial investment of 20 lakh. So 20 lakh is the initial investment. She purchased standard fire insurance policy with the sum insured of 15 lakhs. Recently, a fire damaged her boutique, resulting in the actual loss assessed at 18 lakh. According to the principle of indemnity, the maximum amount of compensation Miss Priya can expect from the insurance company is what? So compensation amount, how you will be calculating, we have seen it fine in the sum insured formula, the principle of indemnity formula. The right answer will be what? Correct answer will be 13.50, which is not mentioned here. So none of the above will be the right answer here. So how you will be calculating? Simply stated, the sum insured, that is 15 lakh, will be divided by the overall value of the insured asset, which was 20 lakh, multiply it by the actual loss, which is 18 lakh, and you will get the answer as 13.50 lakh. Very simple questions are asked in the IIFS examination. If you know the formula, if you know how to apply it, questions are very simple. And one more thing, when we talk about the calculator, so you can use calculator in the examination, and I would highly recommend you to use the calculator, because otherwise what will happen, you won't be able to shell out some more time for the other questions. Calculations, you must make your path simpler by using the calculator. That is the particular suggestion. Then we have, when the price of an ice cream decreases from 50 rupees per scoop to 40 rupees per scoop, the quantity demanded increases from 100 scoops to 150 scoops. Calculate the price elasticity of demand. Now, this question, although it is not mentioned directly in the syllabus, but we know for sure that price elasticity of demand is what? That whenever there is change in price, whenever the price is reduced, we have increased demand. Whenever the prices are higher, we have decreased demand. And this particular phenomena is known as law of demand. How you will be calculating the final price elasticity of demand? It is option D, that is 2. But how? See, simply stated, it is the elasticity will be Q2 minus Q1 divided by Q1 plus Q2 by 2. That is the average of the quantity demanded. And in the denominator, you will have the P2 minus P1 divided by P1 plus P2 by 2. That is the price average. Okay, this is the formula. Again, I am stating that this formula is not mentioned in the syllabus, but if you want to know that, yes, how we can calculate the elasticity of demand, you can directly use the formula. So Q1, the initial price is 100. Q2 is the new quantity. Fine, initial quantity was 100 and new quantity is 150. Price initially was 50 and it has been reduced to 40. That is why the quantity demanded has increased. So just simply you have to put these numbers in the formula and you will get the answer as absolute numbers you have to give. That is why we always take the positive number. We are not concerned by the signs, fine, positive or negative. We always take the modulus here. If the broad money M3 in an economy is rupees 1500 billion and the reserve money M0 is 500 billion, what is the value of money multiplier? So money multiplier, we have seen two formulas. It is equal to M3 by M0. Second formula is what? 1 divided by the reserve ratio. Here what is mentioned? You are given with the 1500 M3 and 500 M0. Only this formula will be utilized. What will be the right answer? 1500 by 500, which will give us C as the right answer. These very simple questions are asked. No complicated question, nothing. Even if you do not have good practice of the particular numericals, then also you can score good while you know only the formulas. Right? So broad money divided by reserve money will give you the money multiplier, that is 3. Then we have, suppose the RBI mandates a cash reserve ratio CRR of 4.5%. So CRR is what? 4.5%. Assuming there are no other reserve requirements and that banks lend out all the excess reserves, what would be the approximate value of the money multiplier based on the reserve ratio? So we know the formula M0 is equal to 1 divided by the reserve ratio, which will be equal to what? 1 divided by 4.5%. Now, since it's a ratio, you have to remove the percentage sign. It will be what? 1 divided by 4.5 divided by 100. And when this will go up, you will get the answer as option C, 22.22 will be the right answer. Fine. Here, the money multiplier formula 1 divided by reserve ratio. So it will be 1 by 0.045. After calculating it, you will get the answer as 22.22. Then we have, suppose the Reserve Bank of India, the RBI, has reserve money M naught of 80 lakh crore. Fine, this is the reserve money. Always remember, M naught is known as the reserve money, 80 lakh crore in the Indian economy. The CRR is set at 5%. So the reserve ratio is what? 5%. And assuming no leakages or reserve requirements are there, what is the potential broad money, that is M3, could be generated in the economy through money multiplier effect? Now, directly it is mentioned that you have to use the money multiplier effect. So the formula which we will use is M3 by M naught, and another formula is what? 1 divided by the reserve ratio. You have to calculate M3, M naught, and reserve ratio is provided to you. Now, since it is in the percentage form, you have to change it into your ratio format. So it will be what? 1 by 20. So directly M3 divided by M naught. What is M naught? It is 80 lakh crore is equal to 1 divided by 1 divided by 20. It will go up and this will be equal to what? 20. So M3 will be what? M3 will come out to be 20 multiplied by 80. That is 1600 lakh crore. That will be the right answer. So D is the correct answer here for this question. Here you can see for yourself the particular you can say calculation is also given. Reserve ratio, you know the formula for money multiplier, then simply you have to put it into the another formula, that is M3 by M naught is equal to your money multiplier. That is why I keep on emphasizing the fact that even if you have no practice at all whatsoever, just by knowing the formula you can solve the question. Okay, next question. So when you talk about this particular question, here you will be uh, asked about the velocity of money, how quickly the money moves between the various components of an economy. So assume that the nominal GDP, gross domestic product of the Indian economy for the fiscal year 2024-25 is estimated to be 300 lakh crore. Right? So the GDP number is provided to you. That is also the nominal GDP. That is factoring your inflation. So nominal GDP is what? 300 lakh crore. If the average money supply M3 during this period is 60 lakh crore, so the M3 is provided as 60 lakh crore. What will be the velocity of money for this financial year? We have seen the simple formula for this particular calculation. The answer will be what? Option B. That is your 5. 300 divided by 60, that is nominal divided by the money supply. Okay, so nominal GDP divided by the money supply will give you velocity of money. And from these topics, you will find questions based on formulas only. Nobody will ask you that elaborate what is velocity of money, what do we mean by money multiplier. No, the answers are very bleak for that. Mostly you will find the formula based question. Very simple formulas are there. Fine. Then we have consumer price index CPI for India, which was, let's suppose, 195.50 in May 2024. So in 2024, it's what? 195.50. 188 in May 2023. So in the previous financial same month, it was what? It was 188.00. What is the approximate inflation rate? So while starting this particular session, we have seen that inflation rate is what? The present rate of index, find the present rate, which is what? 195.50 minus the previous index rate divided by the previous year's index rate, multiply by 100. That will give you inflation rate based on the CPI. So in percentage form, what will be the right answer? It will be 3.99. B is the correct answer. Then we have nominal GDP. Suppose the nominal GDP of India for the financial year 2024-25 is estimated to be 280 lakh crore. If the real GDP for the same period is 250 lakh crore, what will be the GDP price deflator? Now mind it, GDP price deflator is also one of the measure of inflation in a country, right? So deflator, obviously it's an opposite term as compared to inflation. Inflation means what? You are inflating something, prices are growing. Deflator means prices are going down. But very thin line is there, right? Supposing this is the benchmark of the price stability. From here, when the prices go up, you will say that there is inflation. And when from here the prices go down, you will say that deflation is at its play. But as soon as we move towards this particular phenomena, we move from deflation towards stability, or when we move from inflation towards stability, there is always a thin line of defining deflation or inflation via these two opposite concepts. And that is how we define the GDP price deflator as well. So measure of inflation, you have to calculate what? You have to calculate the GDP price deflator. So here it is written that nominal GDP is given, real GDP is given, direct ratio will be 280 by 250. The right answer will be option C, right? So nominal GDP divided by real GDP, 280 by 250 multiplied by 100, you will get the right answer. Simple questions, nothing to be worried about. A state government's financial report shows the following data for the fiscal year in crores of INR. So there are three components provided to you. You need to calculate the drawdown of cash balance for the state government. Revenue receipt given, capital receipt is given, total receipt is also given. We have just seen the formula. Total receipt is equal to what? It is equal to the revenue receipt plus the capital receipt plus the drawdown of cash balance for that particular for the previous financial year for that particular government. Here the state government is asked, so there is no need to change anything. Directly put the values in the formula. Total receipt is what? 75,000 crore is equal to revenue receipt, that is 50,000 crore, plus capital receipt 20,000 crore, and you have to calculate the cash balance. The cash balance here. So this will be what? 70, and just move it here. You will get the answer as 5,000 crore. So A is the right answer. Okay, total receipt minus revenue minus the capital receipt. We have just done what? We have moved the uh, these components to the LHS, right? Okay, 5,000 crore will be the right answer. Next, we have another data for the Indian government's financial data, that is providing you the gross tax revenue, then NCCT transfer to National Calamity Contingency Fund and states share. You have to calculate the NTR, net tax revenue. We have seen that gross tax revenue is uh, uh, nothing but the addition of something in the net tax revenue, right? And when we talk about the net tax revenue, how you can calculate it? Simply stated, NTR is equal to gross tax revenue, subtract from the gross the funds which we keep aside, which the government keep aside for the natural calamities, and subtract the state's share, you will get the net tax revenue. So here GTR is what? 25 lakh crore. Subtract 50,000 crore from here and subtract the overall amount by 10 lakh crore. You will find the net tax revenue. So 25 lakh minus 10 lakh crore, it will be what? 15 lakh crore minus 50,000 crore. You will get B as the right answer, 14 lakh 50,000 crore. Although you can calculate it pretty much quickly, but chances are there that if IIF asks the questions, they might give you some tricky digits, fine, like decimal places also. So always use calculator, keep it handy at least in the exam. Okay, so these are the calculation. NTR is equal to GTR minus NCCT transfer to NCCF minus the state share. Then we have one question based on the borrowings. So calculate the borrowings by the Indian government if the total expenditure is rupees 100 crore, total revenue is rupees 50 crore, fiscal deficit is 70 crore. So from here you can calculate the borrowings very easily. How? So fiscal deficit, we have seen the formula that it is equal to what? The total expenditure minus total revenue, and from this total revenue you have to exclude the borrowings. So just put the values here. Fiscal deficit was 70 crore. Total expenditure is 100 crore minus the total revenue, which is 50 crore minus borrowings. Okay, so once you uh, just solve the particular equation, you will find that minus will be what it this particular 100 minus 50 will be 20, and 20 minus b will be this, fine. So minus minus will be what, plus. So you will have 70 is equal to 20 plus b, and the b is the borrowings will be what, 70 minus 20, which will be option D, fine. That will be the right answer. One second. I think yes, the values are okay, but we have to, yes, we have to subtract this. Now we have to subtract this. So the values will go here, and you will find that this is what it is, 50, not 20. The answer will be 20, right? This will be 50 only. Just wait a moment. The subtraction here, everything is correct, just the numbers were a bit confusing. So it will be 100 minus 50 minus b, so minus minus it will be plus, and 100 minus 50 will be what, 50. This 50 will go here, and the b is equal to, borrowing will be equal to 70 minus 50, which is 20 crore. Okay, this is the formula for your fiscal deficit: total expenditure minus total revenue excluding the borrowings. Next, we have a question based on the calculation of GNP, gross national product. So you are given various data points here. Private consumption expenditure is given, C is given to you. Gross domestic investment is given, I is also given. Then G is provided, government expenditure is there. Exports, imports are provided. So from here, you can directly calculate the X minus M, that is the net exports. And net factor income from abroad is also there. So simply stated, GNP is what? It is GDP plus NFIA, net factor income from abroad. So GDP, the formula is C plus I plus G plus X minus M. So this formula you will add it with NFIA and you will get the GNP. NFIA is what, 20,000 crore, and simply you have to add these numbers. Okay, X minus M you have to add in these three numbers and you will get the GDP. What will be the right answer here? Correct answer is option B, 9 lakh crore. Okay, so formula, definitely if you know, then these are again doable questions. No matter how lengthy the calculations are, always use the calculator. Next, we have consider the following economic data for India, and GNP is provided, depreciation is there. You have to calculate NNP. Always remember, from gross, when you subtract the depreciation, you will get the net national product. So GNP minus the depreciation, you will get the net national product as the answer. So right answer for this question will be what, 12 lakh crore minus 1.5 lakh crore, and C, that is 10.5 lakh crore will be the correct answer for NNP. Okay, GNP minus depreciation. See, the PDF will be provided to you. Also, if you are watching it in the recorded format, you can pause the video and see for yourself that what all explanation is there, because we have covered them elaborately in our classes. Then we have one question. You have to calculate the NDP, net domestic product, when GDP and depreciation is given. Simply stated, we have just seen for NNP, same applies for NDP also. You have to subtract GDP from the depreciation. 8 lakh crore minus 1.2 lakh crore. Right answer will be option B. And when we talk about the actual exam, these type of questions are being asked. Maximum numerical questions are asked in this format only, that 2 or 3 components are given, you have to calculate one additional component. Okay, next we have in the financial year 2024-25, for a hypothetical economy, suppose the private income is 8,000 billion. During the same accounting year, the following values are recorded. So you are being given the undistributed profit of enterprises as 700 billion, corporate profits 1,200 billion, then retained earnings of company, foreign companies, it is 300 billion, taxes paid by the individuals and households 600 billion. Simply apply the formula of personal income and you will arrive at the answer when the private income is also provided to you. So from private income, you have to subtract all this in order to arrive at personal income. So what will be the right answer? Quickly try to use the calculator and tell me the right answer. The correct answer will be your option A, that is 5200 billion. Okay, so private income minus undistributed profit minus corporate profits minus the retained earnings of foreign companies minus taxes, you will arrive at personal income. Simple. Now, next question we have, it is based on the private income. Fine, private income, the corporate's income in a country. Suppose the national income of the country is 10,000 billion. The income from property, entrepreneurship, commercial, and administrative enterprises accruing to the government is 800 billion. Savings of non-departmental enterprises of the government are 200 billion. The interest on national debt is 300 billion. Net current transfers from government to households are 500 billion. Current transfers from abroad are 100 billion. So see, many you can say data points are provided, but if you know the formula for the private income, this is a very easy question. Simply you have to put the various you can say data points in the relevant position. So what will be the private income here? Simply stated, it is derived from the national income. You have to add something and subtract something. So the private income will be what for this question? The right answer will be option A, 9900 billion. Okay, so national income minus the income from property, entrepreneurship, etc., minus the savings of non-departmental enterprises. Fine, because they are not having the core governmental functions. That is why you will subtracting it, plus the interest on the national debt. Whatever the interest is there on the national debt, it will be added in the private income, not in the government's account or the national income. Then net current transfer from the government plus current transfer from abroad. You have to add what? Only you have to add three things. One is your interest on national debt, net current transfer from government, and current transfer from abroad to national income. And subtract what? Income from property, entrepreneurship, and savings of non-departmental enterprises. You will arrive at the answer as 9900 billion. Then we have one question where you have to calculate M1 and M3 money supply. So Reserve Bank of India provides the following data. Currency with public is given, demand deposit, time deposit, other deposits are also given. And we have seen that M1 is equal to what? Currency with public plus your demand deposit plus other deposits with RBI. But when I talk about M3, you have to add time deposit in M1. So for this question, you first have to calculate M1 and then simply add the time deposits, that is 55 lakh crore in that, so as to arrive at M3. The right answer will be what? It will be option A, 37 lakh 40,000 crore will be M1, and M3 will be what? 37 lakh 40,000 crore plus 55 lakh uh, 55 lakh crores, and simply the correct answer for M3 will be 92 lakh 40,000 crore. Okay, so currency with public plus demand deposit with bank plus other deposit with RBI is M1. M3 is what? Currency with public, demand deposit, as well as the time deposit plus the other deposits. Next, you have to calculate M1, M2, M3, and M4. Now, such question you should attempt because chances are really high that you can directly gain 2 marks for sure. Okay. These questions seem difficult, but if you know the formula, again, I'm reiterating the fact these are quite doable. So M1, we have just seen the formula. It is currency with public plus demand deposit plus other deposit with RBI. M2 is what? In M1, you have to add post office saving deposits. So this will be the component of M2. M3 is what? In M1, you have to add the time deposit. So this will be the component of M3. M4, you have to add in M3 your post office total deposit. So this will be the component of M4. So M1 is what? 45 lakh plus your 20 lakh plus 60,000. Right? That will be in crores, your M1. Right? So quickly try to answer this question as well, because I am saying you time and again use calculator. The right answer will be option A. Fine. M1 will be 65 lakh 60,000 crore. M2 is 70 lakh 60,000 crore. and M3 will be 1 crore 35 lakh 60,000. M4 will be 1 lakh 47,000 41 crore 47 lakh 60,000 crore. So big numbers are there because we are calculating what the broad money M3 as well as M4. In this table we have already discussed in this particular lecture. Try to revise this table time and again, because ultimately one question is expected from this table on 2nd of November. Okay. Next, another question based on your the amount, the potential amount which can be created in the Indian economy. A commercial bank receives a new deposit of rupees 10,000. RBI has set the required reserve ratio CRR at 5%. Calculate the total amount of money that can potentially be created by the banking system from its initial deposit. So as you know that the new deposit is what? M naught. M naught is given as 10,000. Here, the CRR is also given, the reserve ratio is also given as 5%. You have to calculate the overall amount, the total amount of money that can be created, that is M3. So simply stated, the formula, again, the same formula will be applied. M3 by M naught is equal to the reciprocal of reserve ratio. So M3 you have to calculate will be equal to M naught, will go here, fine, and it will be what, 10,000 divided by reserve ratio, uh, 1, it will be what, 5%. So 5% will be 5 by 100. It will be 1 by 20. This will move up and you will get 2 lakh as the right answer. Okay. So for this question, right answer will be 2 lakh. That is option A. Fine. So this was it for your numerical class. I hope that you will revise all the formulas which we have done today, and you will attempt these questions in the examination as well. Do not get fearful whenever you see the numerical questions in IFS, because trust me when I say this, they are quite doable. Okay, so this was it for today's session. If you have any kind of doubt, feel free to ask me in the comment section. And for all of you who were asking that how we can maximize our level of preparation, how we can maximize our score in these remaining days, then we have a dedicated power pack revision batch. You can enroll in that particular batch, but before that you should contact the experts for the guidance so that they can guide you in a better manner on this number, that is 0981 981 9247. All the best for your examination.